Hi, welcome back. It's Dennis. Today I want to talk to you a little bit about strategies for a volatile market. I don't know about you, but I think over these last number of months we have really been in a very difficult period of time. And the visibility for what's going to happen over the next 6 to 12 months is even more difficult. If you were to take a look at your portfolio from the start of the year to now, let's say on an average mix of bonds and equities, you would find that probably early on in the year your accounts were up or your portfolio was higher by 4 or 5%. Only over the last month or two to have seen it give that up and maybe a little bit more to where you're maybe down 1 or 2 or 3% for the year. I don't want you to confuse that with being down too much that it's too late to do anything, because I think right now being frozen is not a good strategy. Doing nothing is not working. I think we have to be aware of that the problems in Europe with the sovereign debt and with the bank credit crisis and the problems of inertia in Washington and the dysfunction that we're seeing there could lead global markets to more turbulence. I think you need to be aware of that, and you need to take steps to protect yourself. I think preservation of capital is more important today than at any time in recent history, barring perhaps 2008. But I want to talk to you a little bit about a strategy that I'm implementing, that we've implemented with clients, that'll help ease perhaps the pain or the thought of just doing nothing and that not being the right thing to do. What I'd like to do is give you an example. Let's say that someone had $52,000 in an equity-based mutual fund. What I want you to do is take the money out of the equity-based mutual fund and move it into a sort of a cash position. Then what I want you to do with that $52,000 is every week take $1,000 and redeploy it into the equity-based mutual fund. What you're doing is then taking advantage, or you're buying shares every week. So if the share price fluctuates as a result of the market declining, let's say it gradually goes down from here, you're buying more shares every week. If for some reason the market declines dramatically because of some shock, let's say of a default by one of the sovereign countries in Europe, could cause the market to go into a bit of a tailspin for a while, then this would allow you then to, if you'd like, move more money at a lower price into this underlying equity fund. If markets start to rise because we come to some type of period where things become more settled, then you can redeploy the money back in at a quicker pace. But I think to do nothing is not a good strategy at this point in the game. I think you really have to be proactive. And that's what we're doing. I hope this idea of dollar cost averaging your money over the next 12 months makes sense. If you're interested in further conversation on this topic, or would like to see some of my other videos, please come to the website, www.dennisgraves.ca.